Very good evening, everyone. Standards like Ind AS 101 can be the real game changers, and quite a few candidates ask, sir, which question will be from Ind AS 101? Most likely, question 5B, and in some exams on MCQ also come from Ind AS 101. So, on the round, let's quickly take a look at one question from November 2020, which got a lot of chances of coming this time as well. A Limited has made certain investments in B Limited's convertible debt instruments. The conversion rights are substantive rights and provide A Limited with control over B Limited. A Limited has evaluated that B Limited would be treated as its subsidiary under Ind AS and hence would require consolidation in its Ind AS CFS. B Limited was not considered as a subsidiary, associate, or a JV under previous cap. How should B Limited be consolidated on transition to Ind AS, assuming A has opted to avoid exemption from retrospective restatement or past business combination? This is the question. So, Ind AS 101 prescribes an optional exemption from retrospective restatement. The catch term optional exemption is key, and Ind AS 101 prescribes that when past business combinations are not restated and the parent entity have not consolidated the subsidy as per that is a previous gap, that is accounting standards, so the subsidiaries assets and liabilities will be included in the parent's opening CFS at such values as would appear in subsidiary separate financial statements if the subsidiary were to adopt Ind AS as a parent's date of transition. So if you write till year, at least 2 to 2.5 years secured. So now for this purpose, the subsidiary separate AFS would be prepared as if it were a first time adopter of Ind AS. So the parent will adjust the carrying amount of the subsidiary's assets and liabilities to the amount that Ind AS would require in the subsidiary's balance sheet. And the deemed cost of goodwill will be the difference at the date of transition date between parents' interest in the adjusted carrying amounts and cost in the parent's separate financial statements of its investment in the subsidiary. So the measurement of NCA, that is a non-controlling interest and deferred tax allows, will be from the measurement of other current assets and liabilities. So it should be noted that above exemption is available only in those cases where the parent, as per the previous gap, has not presented the CFS for the previous year, or the CFS were prepared as per the previous gap, but the entity was not treated. For example, in the previous accounting standards, it was already treated as subsidiary. Then all these scenarios, this optional exemption will not be valid. That is it. This is the question. Hope all of you followed. Keep going. Best wishes. All the very best.